Good morning, traders. It is 8:01 a.m. Chicago time on the 21st of July, 2015. It's a Tuesday. Thanks for joining. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Not much to look at as far as news today. Um, should note that IBM reported yesterday after market came in at $3.84 versus $3.78 expected, so better. The revenues missed came in at 20.8 billion versus 20.95 billion expected. With the revenue lower in each major division, the stock traded down 5% in the after hours. Asian markets this morning closed higher. Gold and oil are lower. The U.S. is higher versus the pound, the yen, the euro. We're seeing dollar strength put pressure on commodity prices. Commodity prices are denominated in dollar terms. Looking at what's ahead today, pretty clear deck for today. Not much to be concerned about. We have you need to remember if you're trading WTI August futures, they expire today at 1:30. And then aftermarket today, we have Apple expecting $1.81 and Microsoft expecting 58 cents. Quick switch of gears here to the to what happened yesterday as a review for those who attended. Yesterday's Hypo 1 was expected to be the primary hypo. If you recall me drawing it, was expected to be a return towards the point of control of the prior day. So we were up here when the trader bite was occurring, and I expected it to chop down into 21.15 and a quarter. I expected it to balance here, and then I expected new highs. If you recall, new highs were the all-time high was at 24.50, right around there, and we ended up pushing to 21.26 and a quarter, taking out the new high by 7 ticks. The opening type yesterday was an open rejection reverse. As you can see here, it opened. Let me expand this a little bit. I want to make sure that when I'm doing these trader bites that you're not just taking my word for what is there, that there is a record of what I said versus what happened, and that's what YouTube's good for. So you can go to the channel and look back at any of these videos and compare the expected plan for the day versus what actually happened. It's just a very important way to learn how I'm arriving at these conclusions, and of course through other means I'm also sharing how I'm taking those trades. But for now, we're looking. The opening type was the open was right here. It pushed up. We had a rejection and reversal, came down almost to the point of control, and back out above the opening swing high to new all-time highs above the 24.50. Immediately had a strong impulsive move down at 6.75 point move, which is much higher than normal. And then we had a continuation move that was only a tick deep. This continuation move was only a tick deep, very shallow pullback, and I attribute that to the close. So the expectation overnight is that we continue to push this lower, which didn't happen until just now. So overall, the synopsis for yesterday, rejection of the gap came in early. Hypo 1 was in play. Once the market pushed lower into the prior day's range and failed. You see this failure at the prior day's high right here. This is when I wrote that the expectation was for it to attain 21.15. Didn't quite get there. Again, it stopped 7 ticks short of our target or so. or was it 5 ticks short of our target. And then it walked back up, and you could see as the squeeze happened here on really good delta, you can see that many more people also expected it to go lower. But the overall hypo and plan was for new highs, and that's what we got. Okay, a nice symmetrical move up on these rotations until it failed through with pretty good volume. The overnight high and low were breached yesterday. This is a normal variation day. You can see that the IB low was not breached. The IB high was, and we rotated through the IB high. That makes it a normal variation day. Price action moved higher. We have higher highs, higher lows compared to prior sessions. So let's zoom out a little bit. Look at our 15-minute and what we've accomplished here. Pretty good balance over the last 2 days. These 2 days here, Thursday and Friday, good compression there. Very much ripe to move up. You could see that these 2 days had the point of control within each other. So this point of control and this point of control were in line. Another sign of balance. Normally we throw a microcomposite around that to see how compressed it is. And you can see here that there's a fair amount of volume that took place here. But over 2 days, the volume was pretty low, only 1.69 million traded. Normally we expect 1.1 million contracts to trade in a day session per day. So again, pretty good compression. It finally broke out, and we still have the 2115 quarter and 2114 point of control, MC point of control open. This is the balance point of control right here, and it has remained open. So for today, I'm looking at overall the one-time framing continues. We've been one-time framing for quite some time. Let's see that real quick. One-time framing up means we make higher lows. We don't necessarily make higher highs. It's not necessary. But overall, we've been one-time framing up since down here, since the low. So this is a higher low, higher low, higher low, higher low, and on and on and on. All of these have higher lows. The trend is firmly up. And the buyers are in control. That's what that's showing. For today, again, also value moved higher yesterday. Value and the point of control moved higher. The point of control has moved from where it was in balance and from down here. So the market continues to accept higher prices as value. Another indication of strength. But overall, this does look tired. We do have new highs. The new highs were not taken out by far, and we don't want to anticipate when the top is in. Our goal, despite what many advertisements and gurus tell you, our goal is not to predict the high. Our goal as traders, unless you have very deep pockets and maybe other people's money to trade, our goal is to find the high, to see the high, and then trade off of that high. Not to anticipate it. It's just far too expensive to try to anticipate the high, okay? So when we look at the overnight session, and sorry, my throat is a little dry this morning. The weather's been turning a lot here. The overnight session is showing that the overnight point of control is in line with yesterday's point of control. So this is the overnight point of control. This is yesterday's point of control. This is the prior day's point of control. What is that saying? Despite the fact that we keep moving up in price and value compared to the prior day, the overall participants, the large participants in the market, are steadily interacting at the same price, 21.21. Very important for today. You might want to note that any tests of 21.21 will be sold this morning. That's my plan. Again, trade your plan. This is not a recommendation to trade, but I see good participation by the OTF by a higher time frame at the 2121 as outlined by these points of control. Um, all in line. Essentially, anything above is being considered too expensive. Anything below has been considered too cheap, and the market keeps reverting to these prices. However, this morning I am looking for a test up to balance the inventory, and I'm expecting it to fail at 21.21 or thereabouts, plus or minus 2 points. So it's my primary consideration for today is for the market to be exhausted just for this session. I don't see anything on the news that could potentially cause a revaluation. A very important thing to note, despite the fact that prices have been creeping up, so we have a prices creeping up like that, the delta has been creeping down. So the futures are being used as a hedge. As prices go up, there's a more aggressive tendency to sell into the bid rather than lifting the offer. So the futures are being used by the OTF as they are intended as a long-term hedge, and that's important information to keep. As the markets unwind, these positions get added to. In other words, if the market starts to turn, these positions are added to as the stock positions are being held through the pullback. So it's much easier, much cheaper, and much more efficient to get in and out of futures than stocks. Simply because of the leverage involved and the fact that they're low margined. So what you'll likely see if this decides to roll over, you'll see a very strong expansion on the short side on the futures, again because they are cheap. As the losses accumulate in the stock holdings and the long positions in these funds, the futures will far exceed those in terms of return and use of capital. So that's why futures are as great as they are, but they're also very dangerous due to leverage, folks over leveraging their positions. So that's the plan for today. I'm looking for a return to 21.21, a failure, and then for it to go and test the 21.15 quarter, 21.14 quarter, and then we have this really important CLVN, the cutoff point to the last accepted area up top, and that's the big target for today. It's not far for now. It's only 6 points away, but it is what it is. I expect today's trade to be fairly slow. A quick scan of the other markets. The Euro stocks, pretty good balance that's going on right now. We've had a gap and we've been balancing for a while, and the market there has returned to the point of control, the balance point of control, and is holding. I expect this value to build itself around this point of control over the next day or so. A quick look at the treasuries. The 10 years have been a very interesting trade for those who watch those, but for the last few days, the 10s gap down, and once the Greek crisis has been averted, theoretically, they've been in balance. We've had a trend day down, then we took all of that back, could not breach the gap, and then have been balancing ever since. You can see these points of control moving around in a way that shows that they are just finding balance and moving. Here's your other 2 days of POC balance, and then yesterday POC balance right on the MCV POC. If you don't understand these terms, futurestrader71.com/glossary, and just watch the videos on that website to get up to speed. But overall, the 10 years show no consensus, no real consensus on price. This is not a balanced profile, even though we are trading in a balance zone. So the 10 years are pricing in a potential shift in interest rate policy, later this year. And overall, we expect the MCV part, the MC value area to trade enough to build balance, and once it builds balance, it'll probably start making its move back down. Is the expectation? 125.03 is the next target, next big target down. That's all I had for you. A quick note. I know it's not Trade Wisdom Wednesday. That'll be tomorrow. But a quick note. It's been a tough couple of weeks. I've been trading a long time, and this is not my favorite time. I don't like rallying markets, especially into new highs. I have to rely on tools that I feel are less proficient, less accurate. But overall, you're trading against the OTF in this kind of environment. It is paramount that you keep your risk in check and not get involved with, not marry yourself to your positions. The OTF or the higher time frame participants, the funds, the institutions, and so on, hedgers need you as a day trader for liquidity. This is the purpose we serve. We get paid for liquidity. We're like car dealerships. We don't make cars. We don't destroy cars. We just hold them in our inventory and turn them for a profit. This is our goal, and we take the risk that these cars won't move at a good price. So with that being said, this market is ideal for long-term traders. It is not ideal for intraday traders. Most of the time, in my opinion, the market is good for intraday traders. It's better than it is for long-term traders, but right now it is not. With the Greek crisis resolved, and with the fact that we've had this gappy trend up, these big gaps on the way up. This is a market for investors, and therefore day traders pay the price if they don't recognize this and don't plan accordingly. So this is just a word of caution to let you know that this is not a good time to be aggressive, unless of course you're trading for momentum and on a swing basis. It is a good time to look for short-term failures and keep your risk in check. I know some people are getting hurt by this, and but this is not something that has traditionally lasted very long. The market tends to rally, then drop, then attempt, then drop again, bringing in volatility and volume, then chops around, and then the next move occurs. And that's where we recover some of the losses and get ahead if we have our plan in check and everything in place. Good luck today, and I'll catch you tomorrow. Take care. Tomorrow, Trade Wisdom session, and it'll be separate from the Trader Bite. Good luck. Take care.